Welcome to the deep dive. Today we have a mission that, well, it feels pretty crucial for anyone trying to actively invest these days. How do you actually succeed? How do you become a really savvy stock picker when index funds seem to dominate everything? It's easy to just look at the market and think, okay, the passive giants have won. But we're diving into this fascinating idea that their sheer size, their dominance, might actually be creating fertile ground for investors willing to dig a bit deeper. Our source material today comes from veteran value investor Daniel Gladiš, founder of Vltava Fund. His book, Hidden Investment Treasures, gives us a kind of roadmap, battle-tested, for finding value in these, well, slightly warped market conditions.
Yeah, we're really setting the stage in what feels like a paradox, right? Most of the money flowing into stocks isn't based on someone picking winners, it's just following an index. So the core challenge for you, if you're an active investor, is seeing past these huge automatic flows. We're going to unpack the opportunities this creates, zero in on what Gladius sees as the critical factor, smart capital allocation, and look at some real-world examples.
Okay, let's unpack this right away. Passive investing is everywhere. It's seen as the competition, right? We read articles all the time saying active management is, on its way out. So how can Gladiš argue that the rise of passive funds is actually creating, and I quote, a lot of opportunities for active investors? That feels backwards.
Well, it boils down to what's actually driving stock prices now. Passive funds, they just buy the benchmark components. They don't sit down and calculate intrinsic value for each company. And because they control such enormous sums of money, they're not just taking the market price anymore. They're effectively becoming price makers.
But hang on, if they're just making prices based on flows, isn't that just a temporary blip? Why would a thoughtful investor have to wait potentially years for that to sort itself out?
Because it seems to be more structural than just a blip. When these huge flows push prices around without any fundamental reason, the whole process of price discovery gets deeply distorted, as Gladiš puts it. And the result, market trends, both going up and coming down, are now longer and more extreme. It takes a lot longer for a company's real underlying value to actually get reflected in the stock price. And that creates the window. That's the opportunity for a patient, long-term investor to buy great businesses that the automated crowd just isn't pricing correctly.
That makes a lot of sense, actually, especially when you link that distortion to oversight, or maybe the lack of it. It kind of echoes what Jim Chanos, the short seller, has talked about, this idea we might be in a golden age of fraud. Gladiš points out that these massive passive owners like Vanguard and BlackRock, they don't care much about what's happening in those individual stocks. They have to own them for the index, right?
Yeah.
Regardless of how management's behaving.
Exactly. And if you zoom out, the bigger implication is pretty serious. The stock market's main job, efficiently allocating capital across the economy, well, it starts to break down. If company managers know their biggest shareholders aren't really watching closely, accountability can slip. Capital flows towards the hot trend, maybe not to where it's actually most productive. Now, that's arguably bad for overall economic efficiency, sure. But for a skilled stock picker, this breakdown, this inefficiency, that's your opening. That's the advantage.
Okay, so if the market itself is fundamentally distorted, like you said, then our strategy as active investors needs to adapt, right? We can't just count on the market quickly fixing mispricings. If the index funds are sort of asleep at the wheel when it comes to individual company analysis, where do we grab control? Where's the leverage point for us?
It seems Gladiš points directly at company management. The real shift needs to be towards intensely scrutinizing how management behaves, specifically with the company's cash. A huge part of a company's future value comes down to how smartly managers deploy the cash the business generates. Are they making wise investments for growth? Good acquisitions? Are they paying down debt smartly or returning cash effectively to shareholders?
You mentioned returning cash. One thing that comes up a lot in the Vltava materials is share buybacks. But isn't relying on management to time buybacks perfectly just? Well, risky? Aren't they tempted to buy back shares when the stock's already expensive just to prop it up?
Well, that's the absolutely crucial caveat. Share repurchases only create value when they happen below the stock's intrinsic value. That's key. If management is buying back stock at too high a price, they're, in his words, actually destroying value for the remaining shareholders. So you absolutely have to look at their track record. Are they disciplined? Do they buy heavily when the stock's cheap and ease off when it's pricey?
Okay, so if they are disciplined...
Right. If they are disciplined, the strategic advantage is huge. If you focus on good companies that consistently buy back their stock at low valuations, say 6 or 8 times earnings, you, as an investor, don't even need the passive market to suddenly wake up and notice the company. The company itself is creating its own demand for the stock and, more importantly, increasing the earnings per share every time it buys back stock cheaply.
So in that context, when shares are clearly cheap, buybacks get priority over dividends. Why is that distinction so important?
Well, buybacks, when done right, are generally better because dividends can be tax inefficient and often inflexible. A company might commit to a big dividend and then struggle to keep paying it if business slows down. But a management team using buybacks opportunistically when the price is right, they're actively growing the value of each remaining share internally. Remember, absolute size isn't the goal. It's about how fast your slice of the pie, your earnings per share, is growing.
Okay, theory's great, but seeing it in action really helps. The sources lean heavily on real-time case studies from the actual Vltava portfolio to show these ideas at work. Let's maybe look at 3 different examples.
Sounds good. Let's start with case study A, Asbury Automotive. They're a big auto dealer group in the U.S. Now, their growth came partly from buying other dealerships, sure, but the real value engine, buybacks. They were aggressively shrinking their share count while the business itself was growing. And crucially, when they were doing a lot of this buying, the stock was trading around maybe 8 times earnings. Gladiš calls that a fantastic value-enhancing transaction.
Right, so the key takeaway isn't just that Asbury got bigger as a company. It's that the value of each share you own grew much faster because there were fewer shares outstanding. They were basically using the market's indifference to boost their own per-share returns.
Exactly. Growth always has to be measured on a per-share basis. That's fundamental. Okay, next up, let's look at case study B, Burford Capital. They're pioneers in litigation finance. This is a fascinating example because it's a business where pretty much 100% of the value comes from human capital, the team's expertise in picking and managing complex legal cases they fund.
Okay, for listeners maybe not familiar with this niche, what exactly is litigation finance? Can you give us a quick comparison?
Sure. Think of it almost like venture capital, but for big lawsuits. Burford pays the legal costs for high-value cases, and in return, they get a slice of the final settlement or award if they win. Their returns, their IRR, can be really high, often in the high 20% range. But, and this is key, the stock often gets misunderstood because the timing of when they actually get paid is extremely unpredictable. Lawsuits don't wrap up neatly every quarter.
So the market struggles with that lumpiness.
Totally. And look at the situation right now. Burford has this massive pending case involving Argentina, valued currently at over $17 billion. Burford stands to get about a third of that. Yet the company's entire market cap is floating under $3 billion. The argument Gladiš makes is that the rest of Burford's ongoing business already justifies that current stock price, which means the potential payout from the Argentina case is almost like a free option for a huge upside. The market just can't properly price that kind of lumpy, uncertain, but potentially enormous outcome.
Wow, okay. That's a classic value setup, isn't it?
Oh.
Okay, shifting gears completely now. Let's talk energy with case study C, Cenovus Energy. What's the big picture idea here?
The macro thesis is pretty straightforward. Global growth needs energy. Demand for oil is likely to keep growing, but there hasn't been enough investment in finding new supply globally. So the thinking is oil prices are probably going to trend higher over, say, the next decade.
Okay, higher oil prices, but how do you pick the right oil stock within that?
Well, the approach described avoids the super majors, which can be complex, and also the really high-risk small players. Instead, the focus is on the middle group. Companies like Cenovus Energy in Canada, they have established production, low finding cost, low production cost, and operate in predictable jurisdictions. Less geopolitical risk, basically.
And what's the specific capital allocation angle that makes Cenovus stand out?
Their policy is really disciplined. They've committed to returning all the free cash flow to investors once their debt targets are met. And they do this primarily through aggressive stock buybacks. This strict focus means they're projecting a double-digit free cash flow yield. It clearly shows management is prioritizing per-share returns for shareholders, not just, building a bigger empire.
So investing clearly isn't a static thing, right? It's about learning and evolving. The source material talks about Gladiš's own journey, starting out heavily influenced by Ben Graham's focus on just statistical cheapness after reading The Intelligent Investor way back in '98, but then evolving to realize that often the best investments are the simplest ones. How does that evolution shape the philosophy today?
Well, it leads to having what he calls a benchmark stock. In this case, it's Berkshire Hathaway. It's been a core holding for a long time and acts as a sort of philosophical anchor. Why? Because Berkshire embodies that power of compounding through superior capital allocation, but with minimal perceived risk. You're looking at maybe a predictable 10% or 11% annual return expectation. It's funny, Berkshire is often misunderstood, isn't it? People think of it just as an investment fund, but it's really a collection of operating businesses managed by, well, a capital allocation genius.
And speaking of that genius, Warren Buffett, that statistic is just incredible. Apparently, 99% of his personal wealth was created after he turned 50. It just hammers home the power of that exponential curve, the compounding effect that so many people underestimate because they're chasing quick hits.
Absolutely. And you can't compound effectively if you don't learn from your mistakes. The material candidly discusses some key ones. Take CVS, for instance. That was noted as a mistake rooted in misplaced faith, that new management could actually change a long-standing corporate habit of poor capital allocation specifically, repeatedly overpaying for big acquisitions, which ultimately destroyed shareholder value.
And that ties right back to the passive issue we talked about, doesn't it? If the biggest shareholders, the index funds, aren't actively pushing back on bad capital deployment, those destructive habits can just continue.
Precisely. It enables bad behavior, in a way. Then there's the other kind of mistake discussed. Microsoft. They actually bought Microsoft back in 2010 or 2011 when it was really out of favor, trading around 10 times earnings. Great call. But they sold it too early just because the valuation multiple went up. The lesson there is profound and maybe harder to follow. You have to let the good stories run. Selling a truly great company just because it's not statistically cheap anymore means you miss out on the most powerful part of the compounding journey.
Which brings us nicely to the flip side of the value trap, what's called the growth trap. This isn't about buying something cheap that just stays cheap forever.
Right. The growth trap is paying way too much for exciting future growth potential, only to find out that, well, the growth doesn't quite live up to the hype. The danger isn't usually that the company stops growing completely. It's that you paid, a Ferrari price tag based on expectations of hypergrowth, but the company delivers more like, well, a very solid Toyota performance. Still good, but not what you paid for. The example given is Novo Nordisk, which apparently sold off something like 70% from its peak valuation when it was trading at maybe 50 times earnings. The market priced in perfection and massive growth forever. When the rate of growth inevitably slowed, even if still strong, those expectations collapsed and the stock cratered. #tag outro.
So pulling all this together, the advice for finding these hidden investment treasures seems to be that the current environment with passive dominance is actually extremely favorable for thoughtful, active investors. If you're willing to look below the surface and away from the big headlines and those popular stocks, and crucially, if you're willing to put in the effort to really analyze management and how they allocate capital.
Yeah, at the end of the day, the lasting principle, no matter how markets change, is that investing is always a transaction. You're exchanging your money for a piece of a business, for value. You always have to try and make investments where the price is significantly lower than the value you believe you're receiving. That fundamental truth, that's the bedrock.
Okay, a final provocative thought for you, our listener, to maybe explore further. Daniel Gladiš highlighted that incredible stat, 99% of Buffett's wealth came after age 50. Thinking about that power of exponential compounding, how many investments are you holding right now that you have the conviction, and maybe more importantly, the patience, to genuinely let run for 20 or 30 years? Sometimes the greatest returns demand the most patience, not the most activity.